Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Before kicking off today, I just wanted to let our listeners know that this will be the last Bondcast for a couple of weeks. We're going to take a mini summer break where hopefully markets will be a little bit quieter and we will return in September.
Okay, so we're going to start with you then, Imogen, today, because it was the Bank of England just before we're recording. And I guess the question for you is just an open one. What were your key takeaways?
So, we discussed this meeting at length, I think, in the run-up. I was saying to Ross, our chief UK economist, earlier that I don't remember a meeting where there'd been such a split kind of consensus over whether it was going to be 25 or 50, and also not just what the size of the hike was going to be, but then what that would really mean about, terminal rates and what we might expect in the meetings ahead. But for all that kind of fanfare, it actually was a relatively boring meeting, or certainly in terms of the market reaction, I think. So they delivered a 25 basis point hike, as was really, what the market was pricing, or a little bit less than what the market was pricing. But I think consensus was shifting that way heading into the meeting. We were obviously in the 50 bip camp, but they, you are surprised on the dovish side relative to our expectations then. The vote was, I suppose, a little bit dovish too, just 2 votes for 50 after a kind of overwhelming consensus last week, at the last meeting, and the forward guidance was largely unchanged. But I think that there were 2 elements that I think were the key takeaways that really made this feel, kind of how I would describe as a sort of peaky meeting, if you like. There was definitely some peaky language introduced. And that was, this line that was added to the forward guidance about keeping rates sufficiently restrictive for sufficiently long. And, to me, that gives the sense that they think that they are close to, if not at a peak, and are therefore pushing back on, the market pricing of early rate hikes. But we also got, I guess, this kind of sense that we're at a peak that was reinforced by the forecast. This was an NPR month, their quarterly meetings where we get an updated set of projections. Now, clearly over the last many months, their projections have lost a little bit of weight in terms of a kind of forward guidance signaling tool, just given how large the forecasting errors have been and how little confidence essentially they've had in those, to the extent that they've now announced, a formal review of the process led up by Ben Bernanke this week. But nonetheless, the forecast, I suppose this time round, we're a little bit more consistent with the forward guidance that we got from them. And on the mean projections, which should take into account their sort of asymmetric upside risks that they see on inflation, they did have inflation getting back down to target, or actually just marginally below target, 2% by the kind of 2 to 3 year horizon. The only other thing, I guess, to comment on was that we didn't learn anything on QT. That was very much in line with my base case, although I know that there was some discussion out there that they could maybe trade off a kind of smaller hike with an earlier announcement on the pace of QT next year. They were very clear that would be announced in September, as they had already told us. But there was a sort of box on QT in the monetary policy report itself, which showed that it gave the same glowing review, if you like, of QT that Ramsden gave just a couple of weeks ago. So to me, didn't change our minds that perhaps an increase in QT is coming down the line, but that wasn't one for today.
Okay. Well, I guess that you've already sort of touched on this, but maybe I could just press you to give everyone your concise view of what you think is going to happen with bank rate and QT in the meetings ahead.
Yeah, so it was a little bit more dovish, like I say, this kind of introduction of peaky language. I don't know if that's a technical term, but we'll use it anyway. Was probably a little bit more dovish than we were expecting. It was kind of a complete row back, if you like, from their hawkish reaction function shift at the last meeting. So we've now revised down our expectations of terminal rate. We just have one more hike in our base case. That's to 5.25. To 5.5. It was hiked to 5.25 today. With risks perhaps of an additional hike beyond that, but I think that will be very much data dependent, and there's clearly a lot of data between now and then. Now you might well be asking, with this kind of introduction of peaky language and the forecast showing inflation back down at their target over the 2 to 3 year horizon, why have any hike in there at all in your base case? Which is probably a fair question, but I think really the emphasis on the risks around wage inflation and the risks around kind of evidence of more persistent price pressures stemming from the labor market will be enough to probably deliver one more 25 basis point hike. We think wage inflation could in fact accelerate again next month. And that will probably be enough to keep the majority of the committee voting for another hike. Plus the fact that although the forecasts show them getting back to the inflation target over the 2 to 3 year horizon, like I said before, they have little confidence in their forecasts, and where we have seen forecasting errors, it's always been to the downside on the inflation over the last couple of months. And I think against that backdrop, they would rather err on the side of caution in doing too much rather than perhaps doing too little. So yeah, at least most likely one more hike, we think, and then clearly kind of data dependency heading into November to see whether another hike is likely. And on QT, like I say, it doesn't really leave our views changed at all. We still think that an increase in the pace is coming, but that's really an increase in the pace via just the natural runoff of the portfolio increasing next year rather than an increase in active sales. So our base case is that rundown in the stock is targeted at 95 billion next year rather than 80 billion.
Okay, so it seems like at least on bank rate, you're looking for a slightly lower terminal rate and possibly even slightly lower than what the market is actually pricing in. But how does that feed into your gilt view and so on at this point?
Yeah, I guess the market kind of interpreted this meeting in a very similar way to what we had. I mean, the market was already a bit more dovishly priced in our base case, but the market's almost fully priced, I should say, for a 25 bip hike in September, and then probably sees about a 50-50 chance of a hike beyond that. So very near-term market pricing is hard to kind of push back against with any conviction, because like I say, they are going to be very data dependent for the next couple of weeks, and there's plenty of data to come even before the September meeting, let alone the November meeting. So for kind of front-end gilt yields, I think they're maybe slightly low compared to what I would say fair value is right now, but not significantly so. I might think fair value would be closer to kind of 5%, and they're trading a little bit below that now. But I guess it's not a kind of huge move, that a huge trade that really you'd kind of make a year on in being short front-end rates. For longer dated rates, perhaps today's meeting actually has more implications because, we've been talking for some time really at length about the supply risks and the supply outlook this year. But, for the last couple of months, it's been this, front-end narrative that's dominated the rest of the curve. It's been all about central bank reaction functions. How far are we away from the peak? How big are the next hikes going to be? And I think the closer that we get to a peak in the cycle, the more that we can move away from that narrative driving the whole curve, and actually we can move back to this theme of, supply risk kind of dominating at the long end again. So, I like I've said before, I think those supply risks are to the upside, and I think that, the closer we get probably towards the end of the summer and the more confidence that we have that we're near a peak in bank rate, that can drive yields higher again, led by the back end of the curve. So we still think, we're still comfortable with our bearish view in gilt and still like curve steepness from here. Interestingly, I think, and perhaps this is a good segue into that anyway, clearly the US, in terms of its tightening cycle, is a little bit ahead of the UK, but some kind of timely reminders this week on just how heavy supply will be globally, but in the US as well, serve to kind of bring about a return of term premium there and a steepening of the curve. And I think the UK can follow a kind of similar playbook. So Jan, perhaps that's the perfect time to bring you in, because I think those supply risks are what's really, outside of BOE dominated global markets this week. Let's talk about refunding first, I suppose. How did that fit versus your expectations, and have the market moves off the back of that been as you would expect?
So the Treasury releases financing estimates on the Mondays before the refunding announcement, which comes on Wednesdays typically. And from the Monday's estimates, we kind of got the hint that Treasury is actually anticipating a much larger financing needs than what we had in our forecasts. That's largely due to a couple of reasons, but without getting into too much of the details of why, we do believe that they're a little bit pessimistic on their revenue outlook. We think some large states in the U.S., such as California, for example, were a little bit we're exempt from the tax state, so there's going to be some backdated revenues coming in over the next month. So we think there's going to be some catch up in the taxes that have been kind of relatively slowing down from that side. But that being said, yeah. Like I said, as we got the hint from Monday, issuance was higher than what our forecast was. Just to give some numbers, the sizes of the 2-year, 5-year, and the 10-year auction will be increased the most by $3 billion each every month, and then the 3-year and the 7-year, the 3 and the 30-year will be increased by $2 billion, and then the 7-year and the 20-year will be increased only by $1 billion. We expected the 7-year to see only $1 billion increase. It has been an underperformer on the curve. Similarly, we didn't see any changes in the 20-year, but Treasury decided to start increasing those auctions as well. Probably listeners who track that bond will remember that was just when it was introduced when the 20-year bond was introduced in 2020, it was just consistently underperforming as it was oversupplied. The supply didn't match natural demand. And ever since, Treasury has been gradually decreasing auction sizes there to make it a little bit more, make the sizes a little bit more palatable to investors. Now it looks like we're reversing that. So that's one. Second, bill auctions are about to increase in the coming days too. All of those financing needs, and for Q3, to give the context, Treasury estimates the financing needs will be $1 trillion in net issuance needs. So it's a substantial chunk of money that needs to be raised, and with that, bill auctions will go up. The front end of the bill curve is still fairly rich compared to everything else that normalized a lot faster. So we expect to see some substantial boosts there, particularly in the 4-week and the 8-week bill. And more importantly, going forward, we also got the hint that the next refundings will also see auction size increases. We don't see a reason to think the November announcement would be any different as far as sizes go than this one. And then perhaps again in February, but all signs point towards more and more supply coming in the U.S. And finally, we got a little bit more in Treasury buybacks and what the Treasury intends to do with buybacks. They're all but confirmed now, starting in 2024. We think February 2024's announcement will be the kind of kickoff date. Treasury made it clear that they will kind of give the schedule at each refunding announcement on what they plan to do throughout that quarter. The current plan is to buy $30 billion per quarter, and for liquidity management purposes, and the other $120 billion of cash management purposes will be spread across the year. And for cash management purposes, think something along the lines of, now we have a lot of revenues in April because of the tax season. Let's offset some of that by buying back bills or coupon securities that mature within 1 year, and kind of have like a lumpy maturity, creates a lumpy maturity profile for Treasury. So buybacks are coming. We got a lot more of the details, and probably out of scope of this podcast to just kind of go to each one of them. But they're going to tread carefully, and we're going to start seeing some of the off the runs being bought back at the site, at the expense of more on the runs being issued from early next year.
I guess that theme of more supply coming, or certainly the risks surrounding the kind of fiscal outlook, was reinforced by Fitch's downgrade of the US from AAA to AA. For anyone who's not watching this, you can see that Jan's just sniggered a little bit at me asking the question, because I'm sure he was asked this many times this week, and I'm sure I know what your answer is going to be, but I feel like it would be incomplete for us to not cover that off on the podcast, given that there was so much discussion around that this week. So, yeah, what's your view on that? Does it really matter? And if not, why not?
I mean, it mattered in a way that I had to read a lot of articles about it, and a lot of content yesterday was about the downgrade. But it's just it's a little bit. I don't know. The timing is odd, right? We didn't get a downgrade after the 2017 tax cuts when the economy was doing pretty well, and we just kind of boosted the deficit. We didn't get a downgrade when the debt ceiling dilemma was going on. So it's just, why now when the U.S. economy is just posting very strong numbers? If anything, fiscal stimulus significantly helps growth, and inflation is coming down. So we're not really on like this kind of deficit spiraling environment that changed significantly compared to a couple of months ago. Maybe it's a slow moving process. I don't know. But first of all, the timing is all perhaps even overdue, because like, it's not like we're not at the peak of our deficit spending periods. But I can kind of understand maybe there's some political difficulties in downgrading the U.S. amidst COVID related spending. Right, I get that. But does it matter? Not really. A couple of reasons there. First of all, there's this argument that some portfolios need to hold certain rated securities, and now the U.S. has two issuers that are not rated, rating at AAA, it might lead to some revaluation of portfolios. That's not really that feasible in our mind, because there's no other market that can just absorb the amount of flows that the treasuries do. Maybe on the margin someone might make the change, but I just don't think any risk committee is going to sit there and not make this, if you will, like an ad hoc exemption to the U.S. and just assume like a blanket, that doesn't fit our criteria, now drop treasuries from our investment universe anymore. And that's the main thing. And like for other buyers who have I guess risk-weighted asseting, some measures that use risk weights where treasuries are assigned usually a 0%, like Basel standards and such. That shouldn't really change, because often it's specified U.S. Treasury securities, and even at the AA plus, it still is assigned a zero risk weight. So no, not really much in changes, but you're quite right that it got a lot of sound bites, and I don't think I think the discussion there from the public was very one-sided, as in why.
You sound like a man who's fed up with talking about it. So perhaps we should swiftly move on and switch over to Europe. Giles, we had inflation data this week, perhaps a little less positive than some people had been hoping. How did that feed into, or how does that feed into the ECB's thinking, do you think?
Right. Actually, just before I get on to that, I just want to follow on from the discussion you were just having with Jan on the ratings change for the United States, and I guess, and this is really just a speculation. It's I can't really quantify this in any particular way, but it may shift the way that people think about other countries that have been downgraded from triple to AA, and that may, at the margin, allow people to say, well, okay, maybe I'll take another look at France, for example, and other issuers in that bracket. Anyway, right, yes. So on the inflation, I mean, look, inflation's going in the right direction overall, but perhaps there's a little bit of a disappointment at the pace of that correction. So we had core inflation unchanged at 5.5%, where the expectation was that it was going to continue to fall marginally. And within that, we had services pick up actually from 5.4% to 5.6%. And of course, if you dig and dig and dig, you're always going to find things that are maybe a little noisy that you want to kick out. So people talking about things like the package holidays, for example. We're now in the middle of the summer, of course. So I mean, I think I would go along with anyone who says, let's not get too carried away. I mean, it's yet again just another month that doesn't overturn the trend towards lower inflation. And of course, at the same time, we've got other evidence, sort of macro evidence pointing in a sort of more disinflationary direction. So things like the weaker PMI services that we've had from various countries this week. Labor markets are, again, they seem to be losing some of their momentum / strength. So, while the employment numbers, which in any case, tend to be reasonably strong around this time of year, just seasonally, that they have been, well, let's say a little bit weaker on a seasonally adjusted basis. The unemployment figures have been coming in stronger, as in lower, and so it's a bit of a mixed story. And again, as I've highlighted a couple of times in the in recent weeks, I'm still a little bit worried about the non-core elements of inflation, so energy and food, just possibly posing a little bit of an upside risk over the short term. So overall, I would say, it's not necessarily enough to derail anything that you were thinking, but it's certainly slightly less good news.
I guess going back to the discussion that we were having about, supply risks in the US and what that's done to the curve, we've had some clear bear steepening this week. It's continued pretty consistently, and even a more dovish than expected ECB today hasn't kind of bucked that trend. Not that you might expect it to necessarily. Do you expect that to continue in Europe?
Well, look, I mean, it's been a global theme, hasn't it? It's it's been driven by the Bank of Japan and its sort of step towards ending yield curve control. It's been driven by the supply story that Jan has just been talking us through. So more bonds to come in the US. Not sure to what extent that was really a big surprise. I mean, it seems like it was a small surprise compared to the consensus. We've been talking about this for a very long time, actually, but particularly over the summer. We have been saying that we had concerns about the market's ability to set up in a way that when in the last many years you've had negative supply in August. Now, although supply slows down, it's still there. It's not softened by the Eurosystem purchases at all. And of course, the market comes back and for the supply season in September and October, which is actually pretty heavy. And so, I think it's difficult for lots of investors really to take down the supply in the meantime. And so I think that's part of what we're seeing. But it's been pretty dramatic, right? I mean, we've had 2s, 30s Europe move by about 50 basis points, basically bearish steepening. So 2 years have rallied a bit, while 30 years have sold off quite a lot. 10s, 30s has done about 10 basis points. I do think that this can continue, and I think that this is one of the sort of strategic views that we'll carry for most of the rest of this year. I mean, we'll obviously have it under constant review, but that's my expectation as we speak now. And quantitative tightening and supply, that's part of it. But it's also just the fact that it's much too early, and I think it's been a consistent theme from all of us. It's much too early to talk about rate cuts anywhere really at this point. And without that excitement, as I've said again and again, I think it's difficult to hold on to negative carrying duration, and you really want to be positioned in the front end. At some point, we will be back into a danger zone for the curve where there will be more speculation about rate cuts, and people might want to extend again. And on the basis that you're expecting the turn in rates to come, you might be reasonably happy sitting in a curve flattener or equivalent position, because that's going to come good. But at the moment, I think that the steepening continues.
Okay, great. Well, we won't check back in next week to see if that's correct, but we will check back in a couple of weeks, and hopefully, like I say, we're leaving quieter markets and we can resume in September with plenty to talk about. So yeah, just a reminder to our listeners that today is the last episode for a couple of weeks, and we will be back in about a month in early September with our usual weekly pods. So thank you both for joining me today. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button or click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you in a few weeks.